Welcome to this episode number 103 of Your Next Trade, called today by UNH. So a lot of this to discuss today, between when we started the week with the Chinese tariffs to the end of the week with the downgrade of the US debt by Moody's. So I want to start with the FOMO, the fear of missing out of most traders will have, and something that was very, very true this week was about UNH. So UNH has got a market cap of 260 billion. It is a healthcare company. This is United Healthcare, and has been coming down by 60%, as you can see in this chart, over the last month, due to downgrading their expectations, their outlook, new Trump administration. They fired the CEO, they announced a new CEO. And over the last months, when the market rallied, you had many people telling you to buy after and after. So on the first gap down, this is the one when the stock went down 16%. Many analysts from Wall Street said, this is still a buy. That doesn't change the story. Many people on Twitter, on social media, telling us to be buying. Then the market said, this is not the case. We go down another 27%. So between here and then, we had many traders saying, you need to be buying. Then you need to have another gap, a 9% gap. Then, another calm down. So in between, tons of Substack, tons of Twitter telling you, oh, I made good money on the bonds. The reality is, when you don't have a process, you are creating fear of missing out, FOMO, where retail traders think that, you're going to be touching the lows, that you're going to be buying at the lows, and that you do have a process. So Thursday, Friday was like tons, probably 60 to 80% of the tweets were about UNH. The reality is, you need to have a process. And what was the story? They were downgrading their expectations. New CEO, you do have like a DOJ going after them, and you don't know the outcome yet. So as long as you don't have this real process, you're going to be ending up losing 10-15%. So are you going to be buying at 350? Are you going to be buying at 300 to 60 to 50? So don't get into those fallacy. So now I would like to start, as always, with a week-to-date asset performance, talking about how the stocks have been doing from Monday morning to Friday evening. So that was option expiry week. As always, it's a bit squeezy, but this week was pretty something, where the S&P was up 5.3%, Nasdaq 7.2%, most stocks were up. So this is for the blue color.
Will still
if
in
you look
advanced
at the
talks to become
currencies,
next
this is
Southampton
trading
manager.
sideways for the US dollar versus most currencies. Other asset classes were more or less trading sideways, with gold actually coming down on the week by 3.6%. So let's look at the week to date industry performance, and this one is really interesting. And as you can see here, you do have like the Nasdaq and the S&P around here, so 5 to 7%. And as you can see, the indexes were pretty much on the right hand side of this chart, telling you that you do have like that, not that many industries that are outperforming and pushing the market higher. So we are back to the whole school move, where the market is pushed by semiconductors. We are talking Nvidia, very, very strong due to the tariffs with China. But more importantly, in midweek, we had the Trump administration going to the Middle East, and they announced tons of deals with the Middle East. So that's a funny way to do it. On one hand, to say we're not going to be dealing with China, and to open the gates to the Middle East, knowing that there is a good chance that actually the Middle East will be selling some of their chips to China. But so overall, what we had is really the market driven by very, very few names. We are talking as well the FANG, the Facebook, the Apple, which really are driven the market. So the names that we see, S&P, Nasdaq, as you can see, everything that is above, you don't have that many on the plus hand side, whereas on the minus, you have many more that are underperforming. So overall, this is different from last week in terms of concentration into a very few names. So if you look at the sector performance, you do have like the same consumer discretionary with Tesla that has been doing very, very well. In Amazon as well. So if you look at the XLY, IT, technology doing much better, outperforming the market, where the S&P that is here, and everything that has been defensive. So healthcare really struggling over the last couple of weeks. real estate, same, utilities underperforming, consumer staples. So the normal risk-on market with high beta stock. So if you look at people that have been saying, I've been very smart along the market, the reality is really the high beta stocks, we are talking 1.52 and above, that have been outperforming the market. So anything where you had long high beta, short low beta, you have been outperforming the market like there is no tomorrow. What about the rates? So US 10 years 448. So this is as of Friday. What has been interesting is we are still pretty high for the US 10 years at around 4.5%. On the week, we have been up 10 bips. We came down a bit on Friday morning, but the US downgrade is not going to be helpful. So this is the big news after the US market close on Friday, which is pretty interesting because we had the option expiry. And guess what? Literally after the close was announced, like most of the time anyhow, for the downgrade. At the end of the spectrum, as I said, on the open of the European market on Monday, literally at 8 o'clock, Besant said with these partners and say, we are going to have a deal with China. We're going to be having much better conditions. We're going to go from 70, 80% tariffs to 35%. And the market rallied on that, as we're going to be seeing later. So that explained, part of the moves on the equity. For the bond market, there is still a lot of uncertainties. We do know that the downgrade is coming as well because the US are running a high deficit. We are talking between 5 to 7% of the GDP. Sorry. And that raises question about, how long can we have those high deficit going forward. Now looking at the Fed expectations have been coming down massively. If you look at this December, now we are expecting only 2 cuts for this year, with the first cut being roughly around October of this year. So we moved a long way from 6 weeks ago, where the expectations were for 4 cuts for the year, and for the cut to be starting around June or July. So very, very different conditions. What about the VIX? As always, OPEX, we had a smashing of the volatility. If you look at the 30 days, 17.2. But more interestingly, if you look at the short-term volatility, we are talking 14%. So, and as you can see on that chart, really short-dated volatility has been absolutely smashed, as I said. This is very much the playbook that we had over and over when we gamma squeeze and we go into option expiry, where actually the market is ramping higher and squeezing and grinding, as we're going to see with the 6 days chart later, how the market is doing. So let's jump into the technical analysis. We could be starting actually with the fabulous 7. As you can see, the chart has been about, squeezing here big time from the lows. We have been gapping up since the announcement of China's tariffs on Monday, and we carried on with all the deals that we had with the Middle East. So the chart is pretty much the same as the S&P 500. Last week, I discussed on the S&P 500 that I was looking at 5,800, 5,830. So that was the signal as a short. I didn't have any position, as I said, for the last few weeks. I believed that the market was squeezing, but I didn't want to be involved. I should have, because since 5,500, the market has been squeezing. So I was looking at 5,800, 5,830 as a short. So at the open of the European market, as I said, at 8 o'clock, we had the announcement, and literally the market bumped into 5,830, 5,840. So I tried a small short. We are talking a couple of millions dollars, but that closed really, really quickly. So I lost 10 points on it overall. I didn't want to go against the market. I don't want to go against the market where it's capping at the open with decent volume, and you do know that you're in option expiry week, and actually the market carried. So we finished the week at 59.75. We're going to be having an interesting Monday with the US downgrade. Probably the market, is going to be opening 1% something down. So that is for the S&P. NASDAQ color is exactly the same, with a bit more beta, meaning the outperformance has been a bit higher. But overall, what you see is we are not that far from the all-time high. We are talking 4 to 5% on both the S&P and the NASDAQ. So think about it. We are back to 4 to 5% from the all-time high after good earnings growth, tariffs coming down, and strong momentum But as you can see, if you look here at the bottom, we are overbought in terms of RSI. Even if the RSI overbought doesn't mean that much, because you can be much more overbought. But this is for the conditions. I would like to look at gold. So 3,200, we are down roughly 10% from the highs, from the 3,500 that we touch. Now a bit struggling of the gold since we made these new highs. Why? Because you do have like less buyers, both in terms of the central banks. China has not been as active buying gold last month, but as well you have less inflows from the ETFs, from the retail world, as the retail world has been moving from buying only gold and Bitcoin to buying as well now back to tech and the usual names. So this is no, I want to flag as well that DAX Germany is making new highs, all-time highs, and as you can see, a breakout that happened for the week. So that was another signal as well on Monday that I didn't want to go short any of those markets for the timing. This is what has been happening. If you get option expiry, if you get strong momentum, and if you get many people telling you on Twitter that actually this market doesn't make sense, that you should go short, you do know that there is still a long way for having more pain going forward. So let's go back into the Excel spreadsheet, if I manage to do it, looking at what happened for the week. So this is for the S&P. So that was on Friday. So you see the gap that you have here. That was the expectation that Chinese tariffs will be better. And here you do have like the squeeze that I mentioned just on the European open, where we squeezed from 57.60 to 58.40, where I started the short, and very quickly I closed it. I didn't want, as I said, to get involved, and the market slowly but surely went up every single day, squeezing and squeezing and squeezing due to CPI and PPI. So CPI, we're talking inflation a bit lower than expectation. If you look at the PPI, actually that was negative, and retail sales that were more or less in line. But what we see is the market regime is the same as before. If you look at the sectors, industries, or baskets that have been outperforming the market, it's the same as before. The most shorted that we have here, hard to borrow retail, non-profitable tech. So we are really back to the playbook of 2023, 2024, where you do have like the names that have been going to be squeezed. And this is where the pain is coming from. Anything that is high short interest, more short rolling, high beta will be on the way up. So it's not that difficult as long as you have these market conditions, this market regime. There is no change. You should not be short. If you are long, you keep your long. And when you start to see a rotation, that means the market is telling you something different. I would like to flag as well that we had another deal in the retail space. So if you remember correctly or not, we had Skechers not so long ago where private equity both said that they will be buying the company. This week, Dick's Sporting announced that they were buying Foot Locker at a price of $24, or you could go for shares. So that was an 85% premium versus the close on the week. But what is interesting is the chart is more or less the same as UNH. Okay, so be extremely careful about the FOMO and telling you, oh, I should have been long Foot Locker, because Foot Locker was only at that level over the last couple of months. In between, it went down by 82% between the highs that were in 2021 and the lows of this week. So it's pretty much a very similar chart. That's something that we discussed in depth in the trading community on the most advanced channels. There is strong correlation with the chart of Nike. So if you put Nike versus Foot Locker, that will be very similar chart. But as you can see, don't get me wrong, and about the fear of missing out, the FOMO, where people are telling you, oh, I could have made 80%. Reality, most people, we are talking 99% of the long only world has been losing money on that name. Why? Because that has been a challenging market for Foot Locker, for Nike. This is something that we identify on the community due to retail and their exposure. So we were short. Many of my mentees were short Nike since the 70 and below, despite having those super gurus, hedge fund traders being long and actually close their position. So the second deal that is interesting, that tells you that there is appetite in the retail for the US. maybe either from private equity or for players in that space. So as I said, US downgrade by Moody's, and as you can see, it was on Friday after the close. We went down 30 to 40 points. The Monday open, it's going to be interesting not only for the futures, but as well for the US dollar. What does it tell you? That we do have like the OPEX, and that gives you the rise for the week. But coming back on the downgrade from Moody's that we had after the close. So it's very much the same story that we had in 2011, in August 2011, where we had the S&P downgrade. So Moody's was the last one from the three. We are talking Fitch, S&P, to downgrade the US debt. So in 2011, this is for the S&P. We came down before, so roughly this is when the news came out, and then we really struggled for quite some time, and it was even worse. I don't know if you remember. I remember very well because I was trading that time Europe, and we had a big struggle with the Italian banks. And I remember one trader that decided to sell some call and go away for a couple of days. And then when he came back, it was down $1 to $2 million and get fired immediately. But conditions versus 2011 are quite different. But we do know that the market has been struggling over the last 4 to 5 months with the US exceptionalism, saying, should we be as long as before US assets? Should we be long as much as before of the US dollar? And that's another case for reducing your exposure to the US assets versus the rest of the world in terms of relative exposure. So why is it so? Because we do know that the US are running a high deficit. The debt to GDP, so this is an interesting chart, is coming from one of the macro website. As you can see, debt to GDP 124%. So if you think about it, that over the last 3 years, actually US was running a really strong growth. So you had COVID, but you can argue that 18 months after COVID, everything was back to normal. And in the meantime, US have been running 5 to 7 debt to GDP. Trump administration has been very vocal in saying we're going to be reducing the deficit. It's going to be coming much, much lower. But now the Moody's and the bond market with the years 10 years at 4.5% is really telling you there is a big question mark here. So the risk for you, if you are trading equity, is mostly around credit, is mostly about bonds. Are we going to see the market, not panicking as much as we had for Greece or the UK a couple of years ago? But really, this is the question. We are running in the US 124 debt to GDP, 5 to 7% deficit for the next 3 to 5 years. Trump is going to be pushing for a lot of growth going forward, but that means as well probably a big deficit. And forget about the Doge and saving a lot of money. We do know that it's in the bin now. It's not going to be happening. It's going to be probably 100 billion best each year. It's not going to solve at all the deficit. So really, this is the first thing that we should be looking for this week. What about we look as well at the Chinese retail sales and industrial production that will be announced tonight between Sunday and Monday? We do have, like as I said before, the conferences. So the big one is JP Morgan with the analyst meeting. We're going to have Jamie Dimon and the whole crew telling us, what they think about the macro going forward. And we have as well the NVIDIA CEO at the conference, a Computex conference. That's going to be interesting because on the 28th of May, we're going to have the earnings from NVIDIA. And for the time being, it's all about semiconductors. It's all going to be about FANG, and they are outperforming the market. In terms of macro, we do have like the flash PMIs as well on Thursday. A bit of new home sales building permit, but they are the old ones. We got some G7 meetings. More importantly for me, I have the VIX expiry on Wednesday, which is, which could be a turnaround for the market. We had the option expiry on Friday, but what about on Wednesday, the VIX expiry? So Chinese macro, we're going to have the tariffs as always. Talks probably the Trump administration should announce in the next 2 weeks some deals, because otherwise the market will get a bit anxious. We do have like the Ukraine talk. Probably we are getting closer to talks between Trump and Putin in 101. So flash PMIs, US downgrade. And what about the S&P weekly straddle? As I said, implied volatility has been smashed. We went from 2.3% to 1.3%. So if you think about it, that is the move that is expected from the market for next Friday, plus or minus 1.3%. There is a chance that actually we might be opening at that level. So volatility compression, as always, just after the option expiry, there is a chance that the market could go into a new regime. So this is what I'm trying to figure out if I want to be taking positions going forward. So this is it for me for this week. As always, any questions on the 4x4 or about the mentoring, you can send me an email at greg@Dupont Trading. We do have like the trading community on Discord with 30 channels beyond the paywall. It's $74.99 per month. It's pretty cheap for what you have, trust me. And any other question, you send me an email. This is it for me for this week. Have a good trading week. Bye-bye.